The price to earnings (P) ratio is a widely used metric for valuing stocks. It provides a quick and easy way to evaluate how much investors are willing to pay for a company's earnings. In this video, we'll explore the ins and outs of the P ratio, including how it's calculated, what it means, and how to use it in your investment analysis. What is the P ratio? The P ratio measures the price of a company's stock relative to its earnings per share, EPS. In other words, it tells you how much investors are willing to pay for each dollar of a company's earnings. The higher the P ratio, the more expensive the stock is relative to its earnings. There are two main types of P ratios, trailing P and forward P. Trailing P uses a company's historical earnings from the past 12 months to calculate the ratio. This is the most common type of P ratio and is often used to compare companies within the same industry. Forward P, on the other hand, uses projected earnings for the next 12 months. This type of ratio can be useful when evaluating companies with high growth potential, as it takes into account future earnings growth. The P ratio can give investors an idea of how expensive a stock is relative to its earnings. However, it's important to interpret the ratio in the context of the company's industry, growth prospects, and other factors. A high P ratio may indicate that a stock is overvalued, but it could also mean that investors are optimistic about the company's future earnings growth. Similarly, a low P ratio may indicate that a stock is undervalued, but it could also be a warning sign of underlying financial problems. To get a more complete picture of a company's valuation, investors should look at other metrics in addition to the P ratio. For example, the price-to-sales ratio, price-to-book ratio, and dividend yield can all provide valuable insights into a company's financial health. The P ratio is a popular valuation metric for good reason. It's easy to calculate and provides a quick snapshot of a company's valuation. However, there are some drawbacks to relying solely on the P ratio. Limited scope. The P ratio only takes into account a company's earnings, which may not give a complete picture of its financial health. Other metrics, such as revenue growth and profit margins, should also be considered. Industry differences. Different industries may have different average P ratios, so comparing companies across industries may not be meaningful. Historical bias. Trailing P ratios use historical earnings data, which may not reflect a company's current financial situation or future growth prospects. Growth bias. Forward P ratios may be biased towards companies with high expected earnings growth, which may not materialize. The P ratio is a useful metric for evaluating a company's valuation, but it should be used in conjunction with other financial metrics and analysis. Investors should consider a company's growth prospects, industry trends, and financial health before making investment decisions based on the P ratio alone. By taking a holistic approach to investment analysis, investors can make informed decisions and minimize their risk.